Good morning, this is Ken Long from Tortoise Capital, and I want to review in this video uh, some candidates for uh, good frog style trades for the next trading day. The bottom line is that we're looking for signals or setups or frameworks that make our trade candidates have a good potential to make a larger than normal intraday directional move. So, what kind of things can lead us to that conclusion? The first one is a symbol that has a frog quality number greater than 3. And what that means is that when we take the frog standard deviation and we use that as the marker for the difference between signal and noise, that when we see one standard deviation of price in one direction occur, that there are at least two more units of reward in that same direction that day as a strong potential. So a frog quality number greater than 3 tells us that the ratio of the average range compared to the signal to noise ratio marker is high. So a strong frog quality number is one thing. Next is a symbol that has a high signal to noise ratio, something greater than 0.5. And so we define signal to noise ratio by looking at the last 30 trading days, and we take the real body, which is the absolute value of the close minus the open, and divide that by the range, high minus low. And what that gives us is an aggregate average candle of the last 30 days. So we want symbols that, on average, have more real body than tail, speaking in terms of candlesticks. And that tells us that there are directional moves predominating during the day. So a high signal to noise ratio. The third candidate is a target that has a swing trade signal that is valid. Now, this could be something that the day before was a swing and there's momentum still available and the swing trade exit rule hasn't fired yet, or it could be that today was the first day of a new signal. When we get a swing trade signal, what we're being told is that we have a pattern or a framework or a setup that indicates a larger than normal percentage chance of having a larger than normal move in the next 3 to 5 days. So that target is poised for a sharp response based on a back tested and forward tested validated signal. So if we see a swing trade signal, that's a good thing. Uh, on a simplified basis, an extreme trade location using the Tortoise NDX10. So if we have a symbol that is overbought or oversold, simply on the basis of trade location, we have reason to believe that a correction could occur back in the direction of the mean. So extreme trade location can give us insights for the potential for a larger than ordinary move. If the previous day closed in a doji, then we have by definition a loaded spring. And so a doji is a narrow range day where there is a tension between and a trade off between the buyers and sellers. What that means is with the doji that we have a small relative move to break out from yesterday's high or low of the day. And we know that breakthroughs of yesterday's high or low of the day often are the key price level for what will be a strong directional move, breaking out of the doji in either direction. So the fact that there's a doji leads us to believe there's a higher potential for a big intraday move coming. A special form of trade location and doji is our favorite pattern, the max pain range compression, or the MPRC. And that is something that has, over the last 10 days, experienced a significant sell off, the big sell, we call it, and combined with the previous day closing in a doji, you have the combination of two important market conditions or target conditions: a big sell off, which is, we think, a probability of an overreaction, and then that bad psychology condensing or collapsing down into a doji, which is that small range tension between buyers and sellers. And so now what we have is even a greater probability than a basic doji of an explosive move out of that doji. It could be in the same direction of the sell-off, or it could be a reversion back to fair value if the market concludes that the big sell was an overreaction. But max pain range compression is a very good candidate for a frog on the following day. Having just completed a significant directional move, you might see that by inspection on the swing over the swing trade time frame, or the previous day might have been a large range day. It could have been the first day of a rebound out of a doji, so second day momentum is there. Any significant directional move that jumps out at you may lead you to believe that there's going to be some follow through or retracement momentum the next day. And now underneath the dotted line, we've noted markets and or sectors are poised as the above. So if you have identified individual trade symbols that meet one or more of these patterns, and ideally the more the better, if it turns out that that stock or that ETF is part of a sector and the sector itself also meets these categories, and more importantly, if the market itself also has one or more of these characteristics, then what you have is the synergy between symbol, sector, and market, and you've really got a coiled spring, and now the probability of a short-term large directional move is enhanced. And all of those are well suited for trading through the use of the frog, because the frog is direction neutral, is doesn't require a lot of reasons why. It only reacts to potential moves. And then on a day when you have a large directional move intraday, that's going to be the best move in the frog ever. And so we like to use the frog rules to posture us to act quickly when we see a strong directional move occurring. So keep these in mind as you start evaluating your candidates for short-term intraday moves and are looking for ways to apply the frog other than just the simple frog quality number. There's every one of these signals or conditions creates a potential for your target to make a larger than normal intraday directional move, a large candle day, a large real body day, and that's what you're looking for. So that's Ken Long from Tortoise Capital. Keep your risk measured and powder dry.